Good day. Excuse me. You'd think I'd clear my throat before we started this. Good day, everyone. Today is June the 20th, 2024. This is a read the positioning sort of update. So let's talk about that first of all. As I have mentioned before, the new structure and everything I'm doing now allows me to have the personal channel and put content back up there, right? And if you're not sure where that is, if you go to GTC Traders, the YouTube page, we put it at the very bottom. Right there it is, right? So there's the my more personal channel that I can put content up on again. So I had a few videos, and I basically said, hey, folks, all of you folks that have stuck around for 10 years or whatever it's been, what did you enjoy? Right? And I got a lot of good feedback in DMs and some of the comments on the videos. It's like, what did you always enjoy about this, what I did? And I thank you for the comments. They were very, very kind. Some folks had said it was the best money they ever spent. So thank you for that. Regardless, one of the things that had been mentioned to me is not just doing text, right? I'm an old school guy, so sometimes I just do text. And folks had mentioned to me when you had started, God, when was that? 2012, I think. When you had started bringing in the videos, right? We had the text, we had the, well, in this current iteration, it's read the report and read the positioning, right? Read the positioning is tier 1, read the report is tier 2. But they said we had all the text, but when you did those videos with what you were thinking, that just sort of illuminated everything for us as to what you were thinking. And that's what this is. It's not advice or anything like that. I like the term that DTG uses for themselves. It's a dojo, right? So it completes the whole thought process of allowing ones to look over my shoulder. So here we are with the videos. First one, we don't do them every day, but when there's some things to say about the way I'm thinking about something and the different programs that we run in multi-strat, I thought, okay, let's bring that back. There's not going to be high production quality. There's not going to be beautifully edited. I can tell you that right now because I just don't have the time for that nonsense. All right, we're going to go through stuff, not a lot of editing, down and dirty. Okay. All right, let's take a look at risk. This is the spiders. Let's get started here. This is the spiders for the last few months, right? And we've been doing well, and you may have detected in some of the texts and whatnot, I was a little frustrated because, and by the way, don't take what I'm about to say the wrong way. Don't ever compare yourself to the benchmark on a quarterly period. I mean, you may notate it in your mind, but that's just really silly to do. That's far, far, far too short of a time period to sort of evaluate. That being said, I'm going to do something silly here just to try to describe my frustration, okay, and what I was thinking and why you heard me talk a certain way. It's just an illustration to show you maybe why I was so frustrated, right? So in April, we see risk assets had a difficult time in April, right, back here. We printed a very, very small gain, and then we had a May, and we had a little bit nicer of a month in May, such that we were ahead. Now, here's why I was frustrated. Right here at the beginning of June, right in the beginning of June, we got a signal, and we'll talk more about those here in just a bit, to buy risk assets. And because of the way I was feeling about risk and just a myriad factors, I passed on it. And I said, no, let's just go with some high probability trades, print some black. I think this thing's, did I get the signal to, and am I permitted by the mandate to set that signal aside? Yes. Okay. Systematic discretionary. So I set it aside. And it was right here. It's like buy a basket of risk assets like I'd like to do. And I didn't. I said, nope, we're just going to print just a few basis points, some very high probability trades. We're going to throw an arbitrage trade in there, which is horrendously inefficient when it comes to capital. But although it's inefficient when it comes to capital, it's pretty much it's an arbitrage trade, right? You're going to make money on it. And then some other trades, and we pretty much remain delta neutral. Well, risk ran higher. I should have, coulda, woulda, shoulda, right? You can't do that. It's 50-50. On any individual binary trade, it's 50-50. I don't care what anybody tells you. So we didn't. It ran higher. No biggie. That's why you may have heard some frustration. in my voice. Now, I think if anyone did buy a risk basket, like I often talk about, there's some things to keep an eye on, and I had talked about layering in shorts and when to do that. I had wrote a piece for Mr. Top Step, Danny Riley and Mr. Top Step on their opening print about you got to look for a break in momentum. So let's talk about looking for a break in momentum. What are some of the things I talked about? Now, remember, I like clean charts like this. Because I don't believe in technical analysis. Okay, I do use technical overlays. Technical analysis comes across as like, we're going to predict the future with blah, 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 blah. And it's tea leaf reading. One person will use the same tool, right, to predict two different things. And then they project 4 steps into the future, which is impossible, by the way. And that's not me speaking from a market standpoint. That's me speaking from a scientific standpoint and modeling standpoint. That just can't be done. But they'll model it 4 splines into the future and say, this is what's going to happen. And that's nonsense. It's complete nonsense. However, there are technical overlays and tools that have been used for generations that the market respects and that I will look at. And sometimes it's like, okay, do we have some sort of break of momentum? Do I see a heavy volume push? And let me switch over here. I'm going to switch for a second, just show you some of the things I look at for a break in momentum, because you may have noticed in the text on the position review. Let me bring this over. So we have the position review that we do each day. So come down here, right? The position review. We have the daily note, which is not positions. It's just what we think. But we have the position review, right? And so on the position review, when we were going through things, you may have noticed this little image, and I thought, let me just include this, right? You may have noticed, this is basically, I keep a trading log in each day, just boom, 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 what am I thinking, and then move on to the next day, right? You may have noticed I mentioned there's a mix here, right? 619.24, trust, remember, liquidate, mix if under. So what's that all about? I thought we didn't have the risk mix on. Well, remember, I manage also a trust's assets. And so since I'm managing that trust assets, there are different mandates. I did not catch the risk mix, for my private proprietary firm. I did not catch it for GTC Traders. So that's my frustration, right? The trust operates a little differently. Okay? So the trust operates a little differently, but obviously since I manage it, you're going to see the notes on it. So I figure I better explain that. Listen, I can tell you this right now. When you manage different portfolios, little differences are going to creep in, right? And sometimes that's mandated. The mandate of this trust says that you have to operate this way on this periodicity. Bam, and that's your mandate, and you can't really change that, right? Something like your own private proprietary firm, you may have a lot more discretion on the systematic discretionary portion of it, and it may operate under a different mandate. So the trust stuff that I manage, that's under a different mandate. Okay, so if you see it, it's like, well, wait a minute, I thought you didn't buy the mix, and now I'm seeing trust do different mandates, right? But I am looking at liquidating it. So in other words, dumping risk. So let's talk about some of what you saw on that note here, and what do I look at as far as technical overlays that the market does respect. There's a few of them. So let's talk about that here for a second, and then we'll go through each of them, one of the positions. Well, there's many things. There are pivots. Pivots have been used for generations. Pivots were used by guys on the floor. They would just sort of mentally note where a pivot was at. Like that's the term floor pivots, right? Floor pivots. So pivots have been used for generations. I keep it very simple, as you're going to see. I don't use all the pivots. What else has been used? Standard deviations, right? Standard deviations have been used forever. 1 standard deviation, 2 standard deviations, even 3 standard deviations, depends on the asset that you're looking at. Structures, market structures have been used for generations. These are things the market respects. And yeah, even moving averages is something, 50 and a 200 period moving average. It's been, or 50 and a 100. These are moving average processes. I don't want to say setups. I don't like the term setup. These are moving average processes, because you don't make money from the entrance. You make money because of your risk model, right? But regardless, those are all processes that the market's used and respected for generations. And so why does that happen? Why does the market respect it? I don't know. Like Rob over at DTG likes to just say, because they do, and everybody's looking at the same thing. So use the thing that everybody's looking at. Why? Because that's what everybody's looking at. All right, so breaking momentum.